Oh, so our goal today is to cover chapter 6. I hope you guys got my announcement this morning that I am going to extend some deadlines because I do realize how hard this class is working this week because of the way the schedule turned out, mostly because of the holiday. We had like 3 chapters back to back to back. So if you saw my announcement, I've never held open a test for a few days ever, but I just think it warrants it in this case so that you guys can have part of the weekend at least to study and prepare for that. So if you haven't yet had a chance to read that announcement, just know that I extended the deadline for chapters 5 and 6 and that I'm going to hold the test open for a couple days. So those of you that really count on the weekend to help get a lot of your stuff done will have that opportunity and have that extra study time. So any questions on that if you had a chance to read the announcement? Okay, then I'm going to get started. I'm going to share my screen. I always begin by looking at our schedule. So this is where we are. We're going to cover chapter 6 in one day. And by the way, even if this was a regular traditional semester length class, I always just spend one day on chapter 6 because there's really not that much in it. So as I was mentioning at the start of class, I sent out an announcement today that's going to extend the deadline for chapter 5 and 6, but even more importantly, it's going to give you an extra couple days to get that exam done. So make sure that you take a look at that announcement. I've already made the changes in Connect. I can't imagine that being anything but a positive thing. So having put that up there, I do want to remind you that there, like all weeks, we have a discussion post that's due. You'll see it on the screen. I think that it will motivate you. I've seen this quick video. I think it's about 7 minutes long, probably 20 times. And every time I see it, I see something new and different, and it still inspires me to this day. So I hope you guys will take the time to watch that sooner than later. It may be just what you need to push us to the end of the semester. And then here's our agenda. And again, I encourage you guys to look at the agendas in practicing for your exam that's coming up shortly. I would go through the different agendas and make sure that you can understand or that you can do all the things that you see. So today's sole focus is going to be on the closing process, what we call closing entries. And to be 100% prepared for the class, you should have read the chapter by now. But I do understand that especially in this fast-paced environment, sometimes that's not always practical. So we're going to take our time working through these 4 closing entries that the chapter talks about today. We're going to talk about what closing entries are. We're going to talk about why we even need to bother with them. Closing entries are only done one time on the last day of the fiscal year, and we'll talk about why. And then most importantly, we'll talk about how to do those 4 closing entries. And then like always, I try and build as much class time as I can into getting our hands dirty and practicing. So that's where we're headed today. Does anybody have any questions on what's ahead before we jump in? You can just unmute yourself. Okay, then here's the handout that I'm going to use. Before we go over the handout though, let me put just the picture of what the accounting cycle is. So you'll see this slide in probably 3 different chapters of the PowerPoint. So I'm just randomly pulling this accounting cycle up because this is what our whole class is built around. This whole class is built around, can you complete an accounting cycle for a small to medium-sized business? And remember what accounting is. This goes all the way back to chapter 2. We talked about accounting being an information system whereby financial information is recorded, classified, summarized, and communicated. And so any accounting cycle for any business has to do those things. And then in addition to that, usually higher level up people in the accounting department will do the interpretation of the data. So we're doing this for 2 types of entities in Accounting 100. Right now, we're working on a service-oriented firm in the first 6 chapters. That's a company that provides a service. So again, we've talked about going to a salon or going to a barber, or maybe using a personal trainer, or going to a masseuse, something like that. These are all people which turn around and sell their service for a source of revenue. And then in the last 6 to 7 chapters, we'll be talking about a merchandising entity. So that's what's ahead for us next week. We'll talk about these same steps, but how a merchandiser, someone that sells goods instead of services, what they do to fulfill this information system, this thing called an accounting cycle. So we've analyzed, journalized, and posted in the first 4 chapters. Okay, that's what we learned. So every transaction has to get into the accounting system somehow. So we learn to analyze it, think about what side of the accounting equation goes on, think about the accounts involved and whether they're increasing and decreasing. We spent a lot of time talking about rules of debits and credits that we're going to be using in every single chapter. We learned that T accounts are a great learning tool, but they're kind of messy. And so we learned about a formal written document called a journal, which keeps a financial history of all the events that take place financially in a company. We said the journal's great for keeping that economic diary, but it doesn't have balances on it. And so we had to go to another step to post the data to the general ledger. I'm going to write out GL, just so to make sure that you're comfortable and familiar with what a general ledger does. And then in the last chapter, we learned that the trial balance was the start of that 10-column worksheet. And I was very happy to see over half of you have already finished the chapter 5 homework. So chapter 5 can be a little bit intimidating. That's why we spent 2 days on it. And we learned that a worksheet is an internal tool used to gather together all the adjustment data and to give the owner a preview about what the financial statements are going to look like. Yesterday, we also practiced a reminder of how to do the financial statements. So these next steps, 4, 5, and 6, were covered in chapter 5. And so that brings us to these last 3 steps, really the last step 7 and 8, last couple of steps. We need to know how to close out a company's fiscal year. And so chapter 6 is going to be steps 7 and 8 here. And that last step is something we do at all different points of the accounting cycle. We're always interpreting and using the financial information that we gather. So back to our agenda. What the heck are closing entries? Okay, well, all companies need to have data that is comparable. So for example, if I was interested in buying some stock as an investor in Home Depot, right? And the reason that I use Home Depot is because it's right across the street from the college and you can see the sign Home Depot from the accounting classroom. So that's why I tend to use Home Depot. But you can think about any company that you're interested in. We want to make sure that the information is comparable. In other words, if I'm looking at Home Depot and I want to know how much profit did they generate, I want to look for a specific period of time. In other words, I want to make sure that if Home Depot shows me profit for one fiscal year, then if I'm looking at a competitor, maybe like Lowe's, I want a comparable set of data because they may have different fiscal year ends. And so one of the things we do then is we give every company at that last day of the fiscal year, they get a clean slate. In other words, they have to start fresh. And the analogy I use is something that you guys are probably familiar with. I get a W-2 every year from my employer. It shows how much money I've made and all the taxes that they've had withheld. And if you get your taxes done, so to speak, you guys get this too. And you take it to the tax preparer. And on January 1st, that is wiped clean. And all of a sudden you have a clean slate to start the year new. So if you and I were going to compare what our earnings were per se, we would want to make sure that your earnings were for a year and my earnings were for a year. We want the data to be comparable. And so the closing process ensures a way to wipe the slate clean for whatever type of business entity that we're talking about. So I'm going to go back to this chapter 6 handout, and all of this is in the modules link, as well as the Excel files that we're going to be using. So we already have taken a look back at the accounting cycle. So what we're going to focus on in this chapter are these last few steps of the accounting cycle. Okay, so why do we need closing entries? 2 reasons, as you see on the handout. One reason, to clear out specific accounts. I want you to notice that word specific. We don't close out all accounts. We close out specific accounts. So the first thing I want to make sure we have a good understanding of is, what accounts do we need to close out, right? Well, think about, we've learned 5 types of accounts, right? We could all list them by now: assets, liabilities, equity, revenue, and expense. Think about what types of accounts we need to start the new year off with a clean slate, right? So when I think of assets, I'm looking out the window in my home office here and I see a car sitting out there. Car's an asset, something of value. On January 1st, I don't want anybody taking my car away just because a new year started. And all of a sudden on January 1st, I don't want all the cash out of my account to be gone. So assets are not closed out because assets are permanent, or what your book will call real, R-E-A-L, real accounts. They don't get closed out. So we will not be closing out assets. Okay, and although this is a fantasy of mine, on January 1st, I would love to wake up and poof, my debt would be gone, right? But debt does not get closed out at the start of every year either. So we do not close out assets, we do not close out liabilities, and we do not close out the owner's capital account. Okay, and that's a very common mistake that students make. Think about what a capital account is for an owner. So I'm thinking of my small little accounting corporation that I use. It's a corporation, but let's assume for a minute that it was a sole proprietorship, right? Capital is my net worth in the company. It's what I've been able to accumulate over these past 30 years or so. I don't want to wake up on January 1st and poof, have all that blood, sweat, and tears wiped out. So capital is not closed out either. So again, why do we need closing entries? To clear out specific accounts. Okay, what accounts do we need to close out? Okay, no assets, right? We don't close those. Those are real accounts. And although, again, I wish, no liabilities. Those are real permanent accounts. And no capital accounts, because that's the owner's hard blood, sweat, and tears into the company. So then what's left? What do we close out? Well, think about that accounting equation. What's left? Revenues get closed out. They start the year, the brand new year was 0. Expenses get closed out. They start the new year with 0. And the drawing account is kind of like what the owner's taking out to support his or her family, kind of like our W-2s, right? He or she gets a fresh start too. So what accounts do we close out? Revenues, expenses, and drawing. And there's going to be one more new account that we're going to learn about today that we also need to close out. So let me stop for a second. Any questions on what accounts need to get closed out? Okay, the second reason we do closing entries, and some of you emailed me on this, so I have some very perceptive students in here. I love the emails, and I love the way that some of you are thinking ahead. So the second reason we do closing entries is because you may have noticed on yesterday's problem that when we did this statement of owner's equity, the ending capital balance did not match what was on our worksheet. Okay, well, that creates a problem. So our owner's capital account was increased because of net income, and it was decreased when the owner took money out of his or her account. That caused the capital balance to change. So the fact that I have a financial statement that has ending capital of one number and a worksheet and ledger that have a different amount creates a problem. And so the second reason we do closing entries is to update the owner's capital account so that we can get them to match. And I'm going to prove that to you or demonstrate that to you on one of the homework problems today. So again, we're going through a total of 4 closing entries today. That's all that's in the chapter, really. It's a fairly easy chapter. 4 closing entries, and you're going to see them listed. More importantly, you're going to see them demonstrated. So first major point, if you're taking notes, not all accounts are closed out. Only the nominal accounts, which means temporary, it's a fancy accounting word for temporary, nominal accounts need to be closed. Those are accounts that need to start over with a zero balance. Another common term is temporary accounts. So the types of accounts that need to be closed out are all the revenues, right? Pretty much in this class, we've been using fees earned. So fees earned needs to be wiped out. Expenses need to be wiped out so that they all start over when the end of the fiscal year comes around. We're going to learn about a brand new account today called income summary. And you're going to hear me refer to income summary as a junk drawer. And I use that because in my house, and probably in your house too, you guys might have a drawer that you kind of throw things in during the year just to get it out of the way. For example, downstairs in my junk drawer, I have, if I pick up paper clips, I'll just throw them in there. If I pick up little things here and there around the house that I just don't feel like putting away, I kind of throw them in this junk drawer. And then once a year, I clean the junk drawer out. So we're going to talk about this account called income summary, which you're going to hear me use the junk drawer. It's an account that's temporarily used to hold some numbers, and then we go and clean it out. It's a temporary account that's just used for the closing process. So I'm going to introduce you to that account today. And then our fourth closing entry, will be to close out the drawing. Okay, and there's a reminder for you, permanent accounts are never closed out. What are permanent accounts? Assets, liabilities, and capital. Those do not get closed out. Remember, a big mistake that students make is that they close capital out. And again, that would be like a dagger through an owner's heart. It's like taking everything they've worked hard for all their lives in that small business and wiping it out. We do not close out capital. Okay, so questions on the first half of the handout, which is, what is closing entries? Okay, closing entries are entries that happen one time a year on the last day of the fiscal year, and they're used to wipe out certain accounts so that everybody gets a fresh start to zero on the last day of their fiscal year. Any questions from anybody? And I can't see the chat room, so let me come back in here for a second because we don't have the benefit of having Giselle today. Okay, I don't see anything. All right, how do you do it? Closing is a game of opposites. Okay, so if the goal is to close out a revenue, because that's going to be our first one, think about the normal balance of a revenue account, right? If we were to write our little formula on the board, in fact, let me get a document that I can write on here. Okay, if we were to put this accounting equation down, we'd have assets equals liabilities plus equity. This goes back to day one. And underneath that equity equation, we would have capital, revenues, and of course, expenses are deducted out. Okay, well, we don't close assets, so we won't have to worry about that. And we don't close liabilities. We will be closing the revenue and the expenses. So right now, I just am putting this document up here to remind you about what normal balances are. Normal balances are the side of the account that receives the increase. So revenue accounts, that's going to be the first thing we close out. They have a regular or normal credit balance. So I'm totally pulling this number out of the air right now. Let's assume that we have this revenue account called fees income or fees earned. I don't know what your book calls it. They change sometimes. Fees earned. And let's just make up a number and say that there's $10,000 in that regular old revenue account. The goal of closing entries is to wipe it out, to get rid of it, to get the balance down to zero so that the new year can start again. So if that revenue account normally has a credit balance of 10,000, to close it, let me see if I can change the color of my pencil. To close it, we would do the opposite. We would debit the fees earned for 10,000, okay, to bring it down to zero. Now we know that the debits always have to have matching credits. You can't have one without the other. So where we're going to stick it is in this brand new account that I told you I was going to introduce you to today called income summary. It's what I refer to as the junk drawer. Another way that you might hear me refer to it, it's a dummy account. And what that means, it doesn't serve any purpose except to temporarily hold numbers. And so I debited this fees earned for 10,000 to get rid of my revenue. My credit would be to this brand new junk drawer account called income summary. That account is used to temporarily hold numbers, and then it goes away during the closing process. So step one, wipe out the revenues. How do you do it? Since revenues have a credit balance, the journal entry is going to be to debit the fees earned and credit the income summary. And step one would be accomplished. We've wiped out the revenues. I'm going to demonstrate this to you on our first problem. Right now, we're just going step by step through the handout. Step two would be to wipe out the expenses. Okay, we know that expenses normally have debit balances. So let's go put a couple of expenses in here just for demonstration purposes. I'm just going to throw two in here. Let's say we had, I don't know, rent expense for 5,000 and utilities expense for 2,000. Step two of closing entries is to wipe out the expenses. So if I have those expenses, all expenses have debit balance. My goal is to wipe them out. How do you wipe them out? Closing is a game of opposites. So if they normally have debit balances and my goal is to get them to zero, I'm going to do the opposite. So I'm going to turn my pencil red again, I hope. And step number two, wipe out the expenses. Okay, well, I have two credits here. I have one for 5,000 to wipe out the rent expense, one for 2,000 to wipe out the utility expense. You see that those are both credits. Where would I put my debit? Because we know when we journalize transaction, we need to list the debit first. The total debit would go to this dummy account called income summary. So we have in this temporary holding account two things. Now, this is a junk drawer. It's used to temporarily accumulate the junk, and then we close it out. So this first one, just to remind you, I'm going to call this CJE, closing journal entry number one. That was to wipe out the revenues. And closing journal entry number two was to wipe out the expenses. So again, let's kind of bigger picture, and then we'll continue this problem. Bigger picture, closing entries are required by every single company one time on the last day of the fiscal year. The goal is to wipe out the temporary accounts so that they can start the new year fresh with zero numbers in those nominal accounts. How do we do it? We do it through 4 journal entries. Journal entry number 1, close the revenues. In our case, we had one revenue account called fees earned. Closing's a game of opposites. Since it has a credit balance, I debited fees earned and I credited this brand new dummy account called income summary. That was step one. Step two, close the expenses. How do you do it? Closing's a game of opposites. All the expenses that a company have, they all have debit balances. So if my goal is to wipe them out, I do the opposite. I credited each one of these expenses and the debit for those two went to income summary. Okay, this leads me to journal entry number 3. Now I want you to think about what's in that income summary account right now. We had revenues of 10,000, expenses of 7,000. So if I foot this account right now, that account has $3,000 sitting in the junk drawer. And what do you call the difference between revenues and expenses? We call that number net income. So what are we going to do with that net income? Well, think about what net income does. Net income pulls the owner's worth up. So what I want to do is to get rid of that 3,000, I want to take it out of this dummy account to get it down to 0, and I want to increase the owner's capital account. Why would I increase the owner's capital account? Because net income makes my worth, the owner, go up. So journal entry number 3 is to wipe out the income summary. How are we going to do it? We have this capital balance sitting here. And this capital balance would have some kind of a beginning balance in it. And doesn't really matter what the number is. In fact, I won't even write the number in. What's important to us is this 3,000 that's sitting in the junk drawer in terms of net income needs to be taken out of there and put into capital. Now, last time I tried to change this pencil color, it gave me a problem. Let me see if I can change it to blue. Take that 3,000 out of the income summary. So now that's zeroed out like it's supposed to be, and put it into capital. That is net income. Why do that? Net income pulls my capital balance up. The way that we increase equity accounts is through a credit. So again, back up. What did we just do? We're working on the last year, end of year procedures to close out these nominal accounts and get them back to 0. And the second reason we did closing entries is to update the owner's capital account, because we talked about in the last class, we had a statement of owner's equity capital balance that didn't match what was in our records. So we're going to remedy that in this chapter. So we wiped out the revenues in step 1. And when we wiped out these numbers, they went into this new account called income summary. It's like a junk drawer. So we transferred that 10,000 into the income summary. Then we wiped out all the expenses by individually crediting them and putting the balance in this junk drawer. We foot this income summary account and we got a $3,000 balance. The difference between revenues and expenses we know is net income. So the third journal entry was to wipe out or zero out that new dummy account called income summary and transfer the amount over to the capital. And then the last and final entry would be to wipe out the owner's drawing account. Why would we wipe out the owner's drawing account? Again, kind of think of it as the owner getting a W-2. That's the money that he or she's taken out of the company. Just like you and I has to start over when January 1st comes around, the owner's drawing starts over on January 1st. And so how would we do that? That last journal entry, again, let's just make up a number for drawing. And then we'll go try this. Let me go hit a black pencil again. Then we'll go try this with some real numbers and you can see, remember what this drawing account looks like. It's a weird one. It's a contra equity. And again, I'm totally making this number up. Let's assume that the owner had a drawing of $1,000 during this period of time. We need to wipe it out. Closing's a game of opposites. So if there's $1,000 debit balance in there, to wipe it out, I would credit the drawing account for 1,000 to bring it down to 0. So I just credited the drawing. My income summary is closed out. So I don't want to fill up the junk drawer again because we just closed it out. So I got to put that offsetting debit of 1,000 someplace. Where would I put it? Think about what drawings do to the owner's worth. Drawing makes the owner's worth go down. So where should we close it out? We're going to close it out to his capital account by debiting it. Why would we debit it? Because drawings bring the owner's capital down. And if we had beginning balances in the capital account, we could now foot that new capital account. And what we would find, and we'll do this in our first exercise today, what we would find is now that these closing entries are done, the owner's capital account in the books now matches the owner's capital account on the financial statements. And we're back in that balancing harmony zone again. That's the gist of this chapter. 4 closing entries that all companies have to do one time on the last day of the fiscal year. To be 100% honest with you guys, in an electronic environment, you literally push a button and this is done for you. But because we're understanding how a company's information system works for accounting, we're going to go through the manual process so you can understand what the computer is doing when we close out a month. So questions on that? I think this is going to become much clearer once we jump in and get our hands dirty and go do an exercise. But does anybody have any questions so far? Okay, then let's go get our hands dirty. Let's go pull up our accounting files for today. They look like this. You guys will have a 10-point test question that looks, I think it is this question, honestly, with the numbers changed. So we do have a test coming up. It is scheduled for tomorrow. And for those of you that may have planned your day around taking the test on Thursday, I'm going to open it tomorrow as planned. But if you saw my announcement this morning, this is the first time I've ever done this in 31 years. I'm going to keep that test open through Saturday night. So those of you that are working full time, might have children, and you're just like trying your best to keep up, I just wanted to do whatever I could on my part to hold that test open a little bit longer during a very fast-paced summer class to give anyone that needs it that extra time to study. So hopefully you saw that announcement. Okay, so 10-point test question. Let's put that someplace on your notes. I'm going to go write that up here. 10-point test question. Before we leave today, we'll go look at the format of the test so that you guys can make sure you get any questions answered. And basically what it's going to do, it's going to give you a series of accounts like this problem does. And it says, if I look at the instructions, journalize the closing entries. Okay, so what the heck does that mean? We need to close this year. We need to wipe out all the nominal or temporary accounts. So the goal of closing entries, I'm going to get this into your notes. The goal of closing entries is to wipe out or zero out all of the nominal or temporary accounts and to update the owner's capital account. That's why we do closing entries. How are we going to do that? We're going to do it through a series of 4 journal entries. The journal entries are dated the last day of the fiscal year. So let me spell this right. Journal entries are done and dated on the last day of the fiscal year. Now, if that fiscal year is not in your vocabulary yet, it needs to be. Companies try and create their fiscal year at the slowest point of the year. And a fiscal year is any consecutive 12-month period that a business chooses to operate under. Since companies try and choose their fiscal year based on the lowest point of the year, most companies do not have calendar year ends that you and I typically think of as our year end. So to give you an example, let's just go pull up a couple fiscal year ends and see what type of period we're talking about. So to do that, I think I was looking at Starbucks stock, of course, this morning. But let's look at Home Depot since they're right across the street from a typical classroom. If I put in Home Depot's ticker symbol, make this bigger so you can see it, and I click their financials button, here's their fiscal year end. Okay, Home Depot does not have a 12/31 year end because they're crazy busy with after Christmas sales and so forth. So the Home Depot has a fiscal year end of 1/31. Let's go look at their biggest competitor, which I would guess would be Lowe's. Let's go take a look at Lowe's companies. By the way, this is how much one share of price is selling for right now. You'll probably see it change because the stock market changes moment by moment. But I'm going to go hit the financials. And their year end, you can see that, is also 1/31. So if we were talking about Home Depot or Lowe's, they would be dating their journal entries at January 31st. That's the last day of their fiscal year. So that's just kind of put some real life spin on this. For this company, they are a calendar year tax year, December 31st. So first thing you would do on closing entries is come up at the top of the journal and write in closing entries. I think they told us to use page 4. So while I'm at it, I'll go put a page 4 up there. Page number doesn't really matter till you post. But I'm going to come back here and augment your notes just to make sure that you have these down since it's a 10-point test question. When it says create the closing entries, you need to know that there's 4 of them. And you need to know what order they're in. They're in a specific order. So I'm going to jot those 4 closing entries down here in your notes, and then we'll go do it. So step 1 is to close out the revenues. And we're going to put them in that dummy account called income summary that we just learned about today. So step 1, we're going to go wipe out the revenues. Step 2, we're going to go close out the expenses. And again, we're going to stick them in that junk drawer called income summary. Those are the first 2. You'll see me demonstrate it momentarily. Step 3 is to close the junk drawer, close out the income summary, and transfer the net income, or it could be loss, to capital. So that's going to be step 3. By the way, that one will be the most often missed. And the last one is going to be to close out the drawing. So those are the 4 steps we're going to follow. That's the bulk of this chapter. I would tell you that if you can do this problem right here and you study the vocabulary, there really isn't a whole lot out of chapter 6. I cover this chapter in one day, even during a regular length class. There's not a whole lot in it. So questions on the steps before we actually go do them. Okay, let's go date these then. These would be done on the last day of the fiscal year, so December 31st. And I'm just going to kind of go through here and schedule out what I'm going to do. Step 1 is to close out the revenues. So I'm going to put a little 1 there by the one revenue account that I see. Remember that revenue accounts have credit balances, and our goal is to wipe it out. The handout said closing is a game of opposites. So if that's sitting there on our books with a credit balance, then what we want to do is we want to go debit it. So I'm going to debit fees, income to wipe it out, and I'm going to credit income summary to put it in the temporary junk drawer. that amount is, and I need to look with my either glasses or I need to make it bigger over here, 53,750. And again, you don't have to put descriptions on closing entries because there's 4, they're in a standard order. But I told you when I'm in charge of being the historian for a company and I'm in charge of leaving a historical record of what's happened, I put descriptions on everything. So this is to close out all the revenues. So my revenues now have 0 in it. It's ready to start the new year. The financial statements have been done. Everything for the company's been done. Now we're closing it out. We're getting ready for a new fiscal year. Maybe it's because I have a 1-year-old grandson. The analogy that comes to my head is an Etch-a-Sketch. Maybe I'll show my age. I don't even know if they have Etch-a-Sketches anymore. But that's where you draw on the little board and then you shake it and it goes away. We're shaking up the Etch-a-Sketch. We're getting rid of all the nominal accounts that we've used during the year and getting ready to start the new year. So that's step 1. We've wiped out the revenues. Questions on that first one? And if you guys see something in the chat room, if someone could communicate it to me, that'd be awesome. I can't see it.
So, just really quick, you're going to always put the income summary like debited or credited on all of the journal entries. I just wanted to make that clear.
So income summary is only going to be used in the first 3 journal entries, right? Because after the 3rd journal entry, it's wiped out. So we will not be using income summary in the 4th one. So it's going to be in the first 3. It's a good question. Good question, Justin. Okay, then let's go wipe out the expenses. I think they have 5 of them. I'm going to put a little number 2 here. So closing journal entry 2 says wipe out the expenses. This company, it looks like has 5 expenses. These are all debit balances, right? Because expenses have a normal debit balances. Since closing's a game of opposites, I need to credit each one of these to wipe it out. So as Justin just reminded us, we are going to put them into income summary. I don't know for how much yet, so I'm going to go put a yellow box there for myself, because what I need to do is I need to sum up those 5 credits. After I close every single expense account, I'll go add up those expenses, and when I do that, I'll go back and fill in that yellow box. So closing out these expenses, there's no special order. I'm just going to put them in the order they were given. So depreciation expense, and I'm such a bad speller, depreciation expense has a 2750 debit balance. We're going to wipe it out. How do you wipe it out? Closing's a game of opposites. I'm going to credit depreciation expense, and I'm going to credit supplies expense, not the asset supplies. We are not wiping out any asset accounts, but supplies expense. And whoops, I think I'm 1 off here. Sorry to mess your notes up there. It wouldn't have mattered. I could have jumped to supplies expense, but I see salaries expense. I missed that one the first time looking. So my apologies. Salaries expense, 17,000. Then supplies expense, not the asset. Do not wipe out any assets, but the expense, the amount we've used up, 3,000. And just heading down the list here, telephone expense needs to be wiped out. And utilities expense needs to be wiped out. Okay, so Giselle's not with us today. You guys watch me carefully for errors like that. Let me make sure I got them all down. I'm going to total them up, and that will give me the big debit to income summary, the sum of all my expenses. So let me go up here to the yellow box, type in equal sum, add those 5 up. What we just did is we went in and zeroed out each individual expense, that the company had. So now in our junk drawer, we have 2 items. If you go back and you look at these journal entries, there's 2 things in the junk drawer. I'm going to encourage you guys to make a T account so you don't mess this one up. I know what's ahead, and most of you don't know what's ahead. So just take my word for it. I would encourage you guys to make a T account because there's going to be some other things going through this income summary account later. And so I'm going to make myself, in case you can't see that, a little income summary T account before I do the 3rd entry. Remember, T accounts are great for learning, and that's what we're doing right now. So I want to know how much money is sitting in that dummy account that I need to get rid of. Okay, well, 2 things have gone through here. Here's the first one. We had a credit of $53,750. I'm going to call that closing journal entry number 1 and remind you that that was the amount of the revenues. And then we had a second item, this 30,000 here, go through income summary. So I'm going to write that in, 30,000, closing entry 2. And what that represents is all the expenses. So take a look at that. I want you to foot that income summary. The reason we're doing this T account is sometimes there's net incomes, and sometimes, like during this pandemic, there's lots of losses. And so this journal entry can change depending on whether the company has a net income or loss. So if you make a T account and you foot it and you're visually looking at it, you're much less likely to make a mistake. So when I foot this, I find that we have a credit balance in this case, not in all cases, but in this case, of $23,750. And what is that? That's the difference between revenues and expenses. That is net income. And so what are we going to do with that? We're going to close out this account, this dummy, this junk drawer account, and we're going to transfer it to the owner's capital account. Why? Because net income makes the owner's capital go up. So now that I'm visually looking at it, to wipe this income summary account out, I'm going to debit the income summary and I'm going to credit the owner's capital account. And it looks like that owner's name is Jessica Hunter. For how much? For the net income, for what's sitting in that capital account. And what we just did, we closed out the income summary and we transferred the net income to capital. Someplace in your notes, because I believe this might be a quiz question, it is possible to have a net loss. In fact, very highly likely right now with businesses. If there was a net loss, this journal entry would be flipped, right? In other words, if the expenses were like 100,000 over here, there would be a debit balance in income summary because the expenses would be higher. To close out that debit balance, you would have flipped this journal entry. That's why I'm begging you guys to make a T account. And I hope that came through loud and clear. Make a T account before you do the 3rd entry so that you don't get yourself confused. Okay, let me stop because that 3rd entry is usually the cause of most of the confusion. And by the way, I noticed that I didn't put a description on that 2nd entry. So I'm going to go back up here and just squeeze that in for your notes. That was to close out the expenses. So I'm almost done. There's only 4 entries and we've done 3 out of the 4. Bigger picture, all companies have to close out their accounts. Why? Because for comparability purposes, we want to make sure that everybody has a fiscal year, a 12-month period, so that we can do comparisons and know that the data is comparable. So on the last day of the fiscal year, we zero out not all accounts. We zero out nominal or temporary accounts. What the heck does that mean? We wipe out the revenues first, all the revenues. If this company had more than one revenue account, we'd have to close out each one. Then we closed out all the expenses. Then we looked at this junk drawer called income summary and realized that the net income or net loss is held in there. So we closed that out to capital. Now I want to make one more statement. We never close out capital. We can close things into it, but you don't want to erase Jessica's capital balance unless she's liquidating the company. So I'm going to put that in your notes too. You never close out the capital account. That is the owner's net worth. And it never gets closed out unless the company is actually liquidating. And so the last one, there's 4, we've done 3. The last one is to wipe out the owner's drawing account. So I'm going to go back to this problem. I'm going to go find the owner's drawing. There it is. Jessica took out $26,000 to live on or to support her family. Remember that drawing is that weird account. It's a contra equity. It has a debit balance. So to wipe it out, I need to credit the drawing, and the offset to that will be capital. Why? Because her capital account, her net worth goes down when she takes money out of the company. So Jessica Hunter capital is what we're going to charge the drawing to. And I'm going to wipe out that debit drawing account for the $26,000. And what we just did to wipe out the owner's drawing account and transfer it to capital. Why did we do that? The owner's drawing pulls down the owner's net worth. Now, let me show you what we just accomplished. If I were to go look at the revenue account balances, I would see zeros in all of them because we wiped them out. If I were to go look at the expenses, I would see 0 in all of them because we wiped them out. If I was to go look at the owner's drawing account, you would see 0 because we just wiped it out. So what would be updated, remember, one of the 2 reasons why we did closing entries is to update the owner's capital account. Let's go take a quick look using a T account of what that owner's capital account would look like right now. So you can just draw yourself a T account on a piece of paper, or you can make one using Excel like I'm going to do, just so you guys can see it better. This is Jessica Hunter capital. Let's see what happened to her capital account. I'm going to write what happened to her capital account. Okay, well, let's see what she started out with. I know they gave us a capital balance. I just can't remember what it was. She started out with $60,750. So I'm going to put in beginning balance. That's what she started with. And if I go look at these 4 closing entries, we affected her capital account 2 times. Here, so I'm going to go put that in as an increase. Right there, we made her capital account go up by $23,750. That was net income or closing journal entry number 3. And then right here, we made her capital balance go down by 26,000. That was closing journal entry number 4. That was her drawing. So what does Jessica's capital account look like after the closing process? Well, this is kind of a little miniature statement of owner's equity right here. The beginning balance plus her net income minus her drawing. If I was to foot that, let's see what it looks like. I'm going to take the sum of this side and subtract the sum of the other side. You guys can do it on your calculator. And I got 58,500. Let me give you a second. Again, Giselle's not here, so feel free to double check me on that. That is her ending capital. And here's the good news. That number now matches what would be on a financial statement, right? We didn't have that. We had a problem in the last chapter. When we finished chapter 5, what was on the statement of owner's equity didn't match what was on your worksheet. We've now solved that by doing these closing entries. Now her capital account is updated. Here's her new capital balance. Now, if I were to say, did Jessica Hunter have a good year? We might get some varying answers, and you could argue your point that if it was a pandemic year, you'd take that, right? But just bigger picture, I would say she didn't have that great of a year because her net worth actually dropped. She started out with 60,000 and something, and she ended up with 58,000 and something. So not a great year when your equity decreases. Any business owner right now during the pandemic would say, oh, thank God it didn't change by much. But in a normal time, a business owner's hope is that gradually that capital account goes up and up and up and up. That's the chapter. I'm going to show you one more thing on it. It's called a post-closing trial balance here in a minute. But those 4 journal entries are probably 90% of this chapter. So who has questions?
I have a question,
Sure.
Professor. The T account that you put on the ledger, we don't really put that on the ledger. Was that just for notes or?
So the T account's a learning tool. You wouldn't actually put it in the journal, but you would have a real live ledger account called income summary that you go in and update,
Okay.
right? I'm using a T because it's much easier than making that 4-column ledger account, but you really would be going and updating the ledger with those balances.
Okay, thank you. I just got confused because one you did off to the side and then one you put on the actual ledger, so.
Yes, I was just trying to keep everything on one screen, not to drive you guys too crazy. But wherever we place it, the goal is to see the mechanics behind it.
Okay, thank you.
You're welcome. Anybody else? All right, last step, even though this problem doesn't have us do this, to finish up the lecture for today before we try a couple more problems, the last part of this chapter says do a post-closing trial balance, right? Here's a regular old trial balance. Well, they didn't show it in debit credit form, but they gave us account balances. And the last thing in this chapter is something called a post-closing trial balance. So through the magic of Excel, since we're in the middle of a lecture here, I want to show you what the last step in the accounting cycle would be as far as mechanical. And post, the prefix post, post-closing, literally means after. For example, when you guys took your history classes and you talked about post-war history, that means history that happened after the last World War. So post-closing literally means after closing. And what we would do is we would make a trial balance to prove that after all these debits and credits, the debits and credits are still equal to each other. So I'm going to come off to the side or down a ways and do a post-closing trial balance just to finish up the chapter and finish up the last step of the accounting cycle, I think what's going to make that easier for me is if I just drag this piece of your homework problem down a little bit so I don't have to keep scrolling. And I'm going to come down to the bottom here and really quickly show you what a post-closing trial balance would look like. So post-closing literally means after closing. So you would have your who, what, when. I'm not worried about that too much. I'm going to put down the accounts that would be left. So I want you to think in your head, what accounts would still have balances left in them? Okay, let's think through that. What accounts would still have a balance in it? Well, all the assets should have balances because we didn't wipe those out. And unfortunately, the liability accounts are still going to have balances in them because we didn't wipe those out. And we have our ending capital account. We just figured out was 58.5. That's it. It's going to be a short trial balance. How come? The revenues are zeroed out. The expenses are zeroed out. The drawing's been zeroed out. And the income summary never had a balance to begin with. It was a dummy account, a temporary account. So if we were to do a real quick post-closing trial balance, remember that all a trial balance does is it has a column for debits and a column for credits. And so there's not that many accounts. I'm going to go prove to you that the debits still equal the credits, even after all those closing entries that we just did. So cash, I'm looking up above here, is 33,000. We know that all our assets have debit balances. And accounts receivable would be 2,900. I'm just looking up above. Supplies didn't get wiped out. Supplies expense did, but not the asset. And equipment still has a balance in it, 26,000. Accumulated depreciation was an account that we learned about in chapter 5. It is a contra asset. It still has a balance in it. And our debt still exists. So accounts payable. And all of those other accounts, with the exception of capital, have been wiped out. So my last account here would be that balance that we just finished. I'm going to go carry it down. That 58.5, that new capital balance that's left for our owner is 58,500. And if I did this correctly, and that's a big if, because again, I transpose numbers, so I have to be really careful. Let me go add those up. You'll notice that post-closing means after closing. And when I foot those two sides, they do indeed equal. So last step in the accounting cycle is once you've posted those closing entries, ensure that the debits equal the credits by doing this post-closing or after closing trial balance. And you notice how much shorter our trial balance is now. It's because we don't have that many accounts left open. The majority of the accounts have been wiped clean to start the new fiscal year. Any questions on that? That's the chapter. We did it in about, oh gosh, an hour or so. Now we're going to do a couple more exercises because I always believe that you can't practice too much. So we're going to do some more exercises, but that's the content of the chapter. There's not a whole lot there. Okay. Then if you don't have any questions, I'm going to go on to the next one, but I'm going to give you guys a chance to catch up, to think about that. And again, we've gone lightning fast through 6 chapters in just under 3 weeks. So it's been moving at the speed of sound just about. All right, let's go try 6-2. This is the accounting cycle. So again, I think I mentioned this in a previous lecture. I'm not going to ask you what is step 4. Okay, that would be cruel and unusual punishment there. What I would expect you to do is to be able to tell me what comes first. So I want you guys to take a couple minutes and look at these, and let's give it a shot and put these steps in the proper order. So here's what I mean by that. For example, I know that when we looked at the accounting cycle, analyzing was the first step. So the first step, I'm going to put number 3 here because that was the step analyze. And then I would cross this off, right? And then the next step, what do we do after we analyze a transaction? Well, then we journalize. So I'd put step 4 there and then I'd cross that off. So I'm going to give you guys a few minutes to try and put these in the proper order. And then we'll go through the answer. What I'm hoping to do, and those of you that are watching this at home, I'd hope you would pause the lecture right now. Give yourself a chance to put those in the right order without looking, right? We can all go back to a slide and see the proper order so that we can point out any kind of a weakness that might be there right before a test. So I'm going to be quiet and mute myself. And again, I know my husband would love to be able to use that feature. I'm still here if you have questions, but I'm going to give you a couple minutes.
Just really quick, I just have a question.
Yes.
So this is going to be, so you're going to have to know the order on the exam too, or on the quizzes too.
So I would think so. Now the quizzes, you guys can use your books, right? But the exams you can't. So I won't ask you what is step 4 or what's step 5, but there's probably multiple choice question that says something like which one of the following would be done first, or which one of the following would be done last, something like that. So I would tell you that yes, you should be comfortable with the order.
Okay.
Okay.
I just want to make sure.
Yep. Go ahead and try. Okay, I'm going to bring this answer over. What I would encourage you guys to do is not change your answer, but maybe use a red pen or a highlighter or something and highlight the ones that you missed so that that will point out to you when you're studying that, oh, I need to work on knowing the correct order of those. Okay, so we analyze, we journalize, which means we creating a historical document, but that journal didn't have balances on it. So then we had to post, we updated the ledger. Once we had that ledger done, we did a trial balance, which is the starting point for the worksheet. Once that worksheet had the blessing of management and the owner and made sure everything was done correctly, we do the formal financial statements. There's 3 of those and that need to be done in a specific order. Once those financials are done, we go back and post those adjusting journal entries. Then today's step, at the end of the year, we perform the 4 closing entries that we worked on today. We do a post-closing, which literally means after closing trial balance. And then this interpret is really after every step. We're always interpreting the data. So let me give you a minute to adjust anything you may have put down incorrectly. Use that as something to go back and look over if you missed any of them. And if you have any questions on why you may have missed one, please ask away. Okay. And again, I'll be posting these files. Giselle's not here today, so I'll make sure that I post my files. The answer will be there if that went too fast for you. Let's go, unless I hear questions, we'll go take a look at the next one, exercise 6-3. And back to, I think it may have been Justin or Philip. I don't remember who asked me this, but I won't be having you do an actual post-closing trial balance, I don't think, but there will be multiple choice questions, kind of like that last question, that may say which of the following accounts would be shown on a trial balance, or which of the following accounts would not be shown on a trial balance, and they'll give you some choices. So that's the reason we're going to go over this exercise. I won't have you physically preparing a post-closing trial balance, I don't believe, but there will be multiple choice questions on it. So let's do this problem. It says from the following list, identify the accounts that will appear on the post-closing, which literally means after closing, trial balance. Okay, well, before I even look at the choices, here's what I know is left. These are the things we did not close. So I would expect to see assets, I would expect to see liabilities, and I would expect to see capital. Everything else is gone, bye-bye, zeroed out. So now that I've kind of chicken scratched out what I expect to see, now I can go through these, which accounts will appear on the post-closing trial balance. That's going to be all the assets, cash, accounts receivable, supplies, equipment, accumulated depreciation. Those are all going to be there. My debt still has a balance, and my ending capital has a balance, but all these other ones are closed out. They would not be on the post-closing trial balance because they have a 0 balance. So let me give you a chance to update your records on a post-closing, which literally means after closing. We would see assets, we would see liability accounts, and we would see the owner's ending capital. The revenues are wiped out, the expenses are wiped out, and the drawing is wiped out. Any questions on that one? Okay, then kind of going back to something Brandy asked me earlier today, and she always asks excellent questions. She asked something like, will we do this in the accounts? And I think she was asking me on the ledger, or on the journal. But here's a picture of some ledger accounts with a bunch of numbers in it. And they're going to ask you some questions at the end. This is an actual test question. I think it's 4 or 5 points. We'll go look at the review sheet later towards the end of class, but this is a test question. So I want to spend a little bit of time on it. And what I think I want to do is I want you guys, again, T accounts are so great for learning purposes. So this is a formal ledger. This is the document that we use to keep running balances of all the accounts. But I still think it's going to help you to think about this income summary in terms of this big T account. Okay, and think about the 4 closing entries that we learned today and how they were run through these various accounts. So the first entry right here, the first closing entry that we did that affected the income summary account, that was a close to the amount of revenues. So that's 67,000. That's the first closing entry, and that closed out the revenue accounts. How did it close out the revenue accounts? It debited the revenue account, like fees earned, for example, or fees income. And the credit went to the junk drawer called income summary. The second closing entry we did that affected income summary was to wipe out the expenses. So that second line item here is the expenses. And remember what this T account's doing. Remember what this ledger does. It tracks the balance after every single entry. So the difference between the revenues and the expenses is net income. Here's the running balance. And what we did in that third journal entry is we closed out income summary. There's the net income again, 31,100, and we closed it out into capital. Okay, so in our capital account, again, if you want to think of this as a T, I still do. Here was our beginning balance, just like we did for that exercise, that first exercise. She started off with 120,000. She generated net income. That's where that 31,100 came from. And this must be her drawing, because drawing is the only thing that would have pulled that capital account down. And here's her balance after every transaction. This is what she started with. This is what she ended with, ending balance. Most owners would say over the course of a month that that's a pretty good increase in net worth. So now that we've kind of drawn this picture out for ourselves, and we understand that this income summary is a dummy account, it is used during the closing process and then it got closed out. In other words, it started at 0, it accumulated balances, and it ended at 0. It was used to temporarily hold some numbers from the closing process and then it goes away. Now that we've kind of chicken scratched that out, we can go answer these questions down here. So total revenue for the period. Well, if I look at my chicken scratchings, that was the first thing that went into the income summary account. That answer is 67,000. And total expenses for the period. That was my second journal entry up here, 35,900. Net income is the difference between these revenues and expenses. So you could calculate it by hand, or you could look up at that T account that was computing it for you. Net income was 31,100. 31,100. The difference between the revenues and expenses, maybe I'll put that little note out here. And the drawing that she took out would be the very last thing in her capital account, because it's the last closing entry. She took out 11,000. They could have asked you a lot of questions. They could have said, okay, here's this ledger. What's her beginning capital balance? And you would have said 120,000. They could have asked you, what's her ending capital balance? You would have said 140,100. So this is understanding how the documents work. So again, I can't remember exactly. We'll go look in a minute. It's maybe 4 or 5 points. It's this exact question with the numbers changed. So before the exam, I'd go back and I would redo this problem. I'd put my notes aside, maybe open up a new spreadsheet, because you guys always have the ability to download the Excel spreadsheets. Maybe download it again, put your notes away and try it before the test. Make sure you can do it correctly. Any questions on that? All right, then the last one is just some more practice. So they give you some ledger accounts. They don't tell you what normal balances are. We have to know that by now. We're 6 chapters in. They do tell us that all accounts have normal balances. And here's what they want you to do. Prepare the 4 closing entries. So this is similar to that 10-point test question that we did earlier. I'm going to give you guys, I don't know, 5 minutes or so. And let's see how well you can do this. And I'll show you the answer at the end of the 5 minutes. I'll get you started. Remember, there are 4 closing entries. Can you list them? So I'm going to list them for you. Step 1, we're going to close the revenues. Step 2, we're going to close the expenses. Step 3, and probably the hardest, so I'm going to put a little couple of asterisks there. We're going to close income summary. And lastly, we're going to close the drawing. You guys have a 10-point test question. Let's see how well you do. And again, if you're watching this at home, pause this, take 5 minutes and try it. And then that's how we assess ourselves. That's how we find out whether we understand or we're a little weak on this and still have to spend some more time studying. So I'm going to mute myself again. I'm going to set my timer for 5 minutes. We'll come back and look at the answer, and then we'll look at the test review sheet. See any questions? All right, I'm going to set my timer. I'm going to mute myself, set my timer. I'll scroll up as soon as I know that you've had a chance to write those 4 steps down. Have you guys had enough time to get an answer? Anybody still working? Okay. Let me bring the answer over here. Again, I want you to circle the ones you missed, get a red pen, highlighter, get something, but I want you to notate to yourself that you missed it because this is 10 points. So first thing I would see if you were in my classroom doing this on a piece of paper, I should see closing entries written at the top. Second thing I should see is the correct date, March 31st. This is their fiscal year end. The first entry would be to wipe out those revenues. The second entry would be to wipe out those expenses. How do we do that? With individual credits to each expense and one big debit to income summary. That third one, you could have made a T account and you would have taken the difference between these two. I'll make them green. And when you take the difference between those two, you would have got a net income of 121,100. That net income increased the capital account. And that last journal entry would have been to close the drawing. If you were able to do that problem, you got the chapter down. And if you struggled a little bit, it's probably because maybe you haven't read it or you need to do a little bit more practice until that light comes on. And chapter 6 out of the 3 chapters that we've done on this next exam, 4, 5, and 6, I think chapter 6 is the easiest. I think the homework will probably take you an hour or less. It goes pretty fast. So any questions? All right. Not hearing any questions then. Let's go take a look at the exam sheet. So this is in the modules link. If you scroll beneath chapter 6, you'll see exam number 2. And it just kind of summarizes topics on your test. So it says this exam covers the last components in the accounting cycle. You should be familiar with the major steps and be able to place the steps in the proper order. Okay, we just did an exercise that tested us on that. Topics include journalizing, journal entries, how to post, the ledger, how to do the cross references, errors, okay, which tends to be a tough topic for most students. The trial balance, computing adjustments, creating adjusting entries, the worksheet, financial statements, and today closing entries. So here's how the test is set up. 23 multiple choice questions worth 2 points each. So that's 46 points. It's about a 50-50 split, right? So about half of it's multiple choice. And the rest are a series of short problems and long problems. Okay, the correcting entries, that's like the last problem in chapter 4. The one where the accountant had made 3 errors and you had to make correcting entries. That's 5 points. One of the longer ones is like most of your homework in chapter 4, where you journalized and you posted. Then there's a fairly short problem that will ask you about the 3 adjusting entries that we discussed. That would be supplies used, the prepaid used, and the depreciation. There is a worksheet that will take you some time, so you're going to have to watch your time on this. You can't sit there for an hour and look at a worksheet. And by the way, it's never all or nothing. I give you points for the correct stuff that you do. So for example, on a worksheet, you may have one small mathematical error that you just missed, or maybe you're missing a part of a heading or something. It's not, gosh, I missed something, I'm going to get 0 points. It's like I missed a little calculation or I put something in the wrong column. You might get 9 out of 10 points. So the worksheet is something that you need to practice. And when I say practice, it's not just to be sure that you can do one accurately. It's you got to have done a few during the homework time so that you can do one and not take a vast amount of time doing it. And then the financial statements, that will be on every test you take. We'll make sure that you remember how to do an income statement, statement of owner's equity, and balance sheet. That question that we just looked at today, there is that, I told you I wasn't sure if it was 4 or 5 points. Here it is, it's 4 points. It's that exercise that we did earlier today where they gave you ledger accounts and you had to identify the revenues, the expenses, the net income, and I think the drawing. That one wouldn't take you more than a minute or two if you understand how to do that homework problem. The last one that we've been working on today, the 4 journal entries. We had 2 exercises today that would very much look like the test. You need to be able to wipe out the revenues, wipe out the expenses, wipe out the income summary, and wipe out the drawing. Study time, again, I do have a heart and I do understand that this class goes very fast and that some of you depend on some of the weekend to get your studying time in. So if you got the announcement today, I am going to extend the test. I'm still going to open it on Thursday in case any of you made childcare arrangements or work arrangements. You can still take it on Thursday as it's scheduled. But to help the rest of you out by giving you a little bit more time, it's going to close Saturday night. I did extended the due dates for chapters 5 and 6. You'll see that in an announcement today. In fact, why don't I just go grab that announcement so we can all take a look at it, make sure there's no questions. Give me 1 second. Okay, so chapter 5, which I think was originally due tonight, will be due tomorrow night. Chapter 6, which is very short, we did all the problems in about an hour today, will be due the following night, Friday. The Learn Smarts and the Smart Book I extended till Saturday. And then that proctored exam will open Thursday. For those of you that already made arrangements, go ahead and take it as scheduled, but will stay open until Saturday. Hopefully that eased some of the stress that we can feel during these fast accelerated classes. We do not have class tomorrow. It is a study day. I want to give you that class time to be working towards the exam. Giselle wasn't able to join us today. I'm hoping that she still has her Zoom hours tonight as she's scheduled. And she's definitely going to have Zoom hours on Thursday during class time. So you may have seen that I canceled the class. It's because I originally had scheduled to give you that day to practice. I'm not going to change that up on you. So if you need help, you need tutorial help, Giselle will be in her Zoom room during class time tomorrow. And you guys can use the time to study. Any questions about anything on that test review sheet, anything on questions? By the way, the fall schedule is open now at Cerritos. So be thinking about what fall classes you want to take. If you guys have questions on those classes, I'll do my best to answer them. And if I don't have an answer for you, I will try and get one for you.
Professor Johnson?
Yes.
I had a question for one of the problems for chapter 5.
Okay.
Homework.
Okay.
Yeah, let me just get it real quick. I had to do something with like the overstated and understated.
Oh yeah, that was a tough question. Okay. You want to share your screen?
Well,
or if
I'm
not,
doing it on the phone. So
oh, you're doing it on the phone. Okay. So what I would encourage you to do, Jason, on that is to write down the accounting equation. So I'm going to share my screen. And I think the best way to do that is to write down the accounting equation. So let me get an Excel spreadsheet up here, just any old spreadsheet. Let me open up a new one. So this is what I would do. I'd put assets equals liabilities plus equity. And the question was, what is the effect that those errors had on the assets of the company? And I think this is that test question also. So what you would do is take a look at those journal entries, the correcting entries, And anything that affected an asset, you would keep track of. Some of them made the assets go up and some of them made the assets go down. And so what you would do is anything that affected an asset account, you would place in this column and then you would foot it, and that would be your answer. So try that at home. If you still can't do it, email me and I will do it for you. I mean, I'm not going to do it for you, but I'll use a T account with the numbers that your problem has and show you how to come up with that correct answer. Does that work for you?
Okay. Yeah. Thank you.
Jason, do you have access to email?
Yes.
Yeah. Okay. So try it one more time by setting up an accounting equation and just looking at the asset side, because that's what it specifically asked you about. See if you can get it. And if you can't, email me, say I'm having a problem with, question number, and then I'll shoot you back a solution with the accounting equation written out on this is how I came up with that number.
Okay. Thank you.
You're welcome. Anybody else have any questions? All right, guys, I will be sure to check my emails over the weekend. Remember Giselle's tutoring hours tonight and Giselle's Zoom hours during class time tomorrow. It'd be great if you guys can try and crank the homework out, and that way you can take advantage of the tutorial hours or get assistance from me during office hours. I was in my office again all by myself today. I'd much rather work with you guys than work on paperwork. So never hesitate to come in. All you do is click on the red button on the home page to come and see me during office hours. I wish you the best on your test, and I'm still here if you guys need help. Reach out. Bye.
Thank you.
You're welcome.